Welcome to Dads and Dollars podcast with your host, Stanley Funches, certified financial planner, business owner, author, speaker, and father of three. Listen as Stanley shares his valuable insights around fatherhood and finances gained from over 20 plus years of experience. You'll hear stories, lessons learned, and the ups and downs he and his guests have encountered on their journeys as fathers, professionals, and business owners. These shared lessons will help provide you a path for financial independence while celebrating the challenges of being a dad. Thank you for joining the conversation. Here's your host, Stanley Funches.
Good day. Welcome to Dads and Dollars, the podcast where fatherhood and finances are woven into many life topics. My name is Stanley Funches. I'm a certified financial planner by profession and a father of three in this thing called life. We are glad you can join us for season 1, episode 21. And in this episode, we're going to talk about my first love, basketball. But first, before we get into that, we're going to talk about something that each one of us love to hate. So let's get ready to rumble. So I recently had a conversation with a few people, and we were talking about, again, this thing that we all love to hate. And as a financial planner, it's a necessity for us to make sure we cover these topics with each one of our clients, and that's insurance. Now, hold on, before you guys turn off the podcast and be like, I'm gonna go on about my day to something else because I don't want to hear anything about insurance. Just bear with me. I think this is gonna be a good listen for you. But so we were talking about that, and the concern is, why is there such a bad rap? Why do people not like insurance and insurance? It's one of those things that there was a saying when I was growing up: is better to have it and don't need it versus need it and don't have it. Insurance falls in that category, right? We hate paying for it. I mean, I hate paying for it. Everybody hates paying for insurance, but you're never upset when we need it and we have it, but we're always upset when we don't have it, right? So again, never upset when you need it and you have it. There's nobody that ever really said, man, I wish I didn't have so much of that insurance when my car was total, or, my spouse passed away and we have all of these debts and take care of the kids. I wish I didn't have all this insurance money. There are different times that things come up and we can't self-insure. And so that's why we have insurance policies. And so but it's one of those things that we hate paying for. And because of that, there's a lot of sour taste in our mouths when it comes to insurance policies. And when you think about it from a financial institution standpoint, insurance companies are probably some of the more solid financial companies in our country. They're heavily regulated, and it seems to be somewhat secure for many in the industry, but yet people still don't care for them as a company. And I think that you can talk about property and casualty insurance, and if the car is wrecked, how much money you get, and blah blah blah, and whether you get your claim paid, and all those things are very true, and those things happen in the property casualty world. But I want to focus more on how we think about, especially as a financial advisor, how we think about life insurance. So we have the insurance companies and have the negative connotation on that, but then everybody think about, okay, hey, life insurance, at some point in time, we're all going to leave this earth. And when we leave this earth, what do we leave behind? And do we leave it prematurely before we're able to build the assets so that we could pass something? And so that's why I want to kind of focus, say, hey, insurance, but then what are those different types of life insurance, and how do they fit? And where is this bad rap coming from? So why does even life insurance have a bad name? Because unlike property and casualty insurance, where there's somewhat of a question of how much money you get, and whether they're going to pay for the claim, or if your roof shingles blow off, if they're going to pay for the roof. That's all questionable. But life insurance, if you pay your premium, right, you pass away, there's no controversy. It's the amount, the death benefit is there. And so why does life insurance have a bad name? Look, I can just talk about from my history. When I was a kid, probably from the earliest parts of time that I can remember, up until my grandmother passed away, I can remember being out in the yard playing as a kid, and this man would walk up probably once every couple of weeks, maybe even weekly. He would come up, knock on the door. My grandma would give him money, and he would give her a slip. And she was paying for these life insurance policies. And it was, I don't even remember what the name of these type of policies were, but they supposedly had some little cash value. And I guess if you're in the African American community, you probably had this a lot where your grandparents, or depending on your age, would pay for these policies from these people who just come around knocking door to door and come by on a weekly basis, bi-weekly basis, or whatnot. And so this happened for probably over 25 years. But yet when she passed, the insurance that I saw her pay for nearly 25 years barely covered her burial and funeral arrangements. Now, as a kid, I don't know how much her premium was. I just know she paid for it for a long time. And it would have seemed to me that would have been a more substantive amount of money. And so again, that's my orientation when it comes to life insurance. It's like, yeah, people pay for it and it pays a benefit at the end, but is it actually meeting your needs? Is it really substantive with what you're putting in it? And so I think all of us, what gives insurance companies a bad name, or give life insurance a bad name, we have a predisposition based on how we grew up. If we had any experience with that at all. And then just being in the industry, I do know that when it comes to life insurance, look, it takes a certain amount of convincing people to purchase something that they don't want to pay for, right? And ultimately, it will not benefit them personally. So you're asking somebody to pay for something that they don't want to pay for, and it won't really benefit them. Now, they may have some goals about taking care of their family, but really, we pay for life insurance for our family. We won't be here to enjoy those dollars, or even see our loved ones enjoy or live off those dollars. So it takes some convincing for that purchase. But in that convincing or sales process, however you want to think about it, the client's or the purchaser's best interest, given their goals and resources and the purpose of the dollars, need to be in the forefront. And I think this also gives insurance a bad name, life insurance a bad name, because a lot of times those things often aren't aligned. Oftentimes people get something that they don't understand, that they can't afford, and it doesn't truly fit their long-term financial plan while they're living. And so that's one of the things I would tell each of you because we all have a need for life insurance. Even if you're the wealthiest people, sometimes the wealthiest of people have the most life insurance. But we all have a need for it. It's just making sure that those things are aligned with our goals, our resources, our purpose, that is something that we can understand, we can afford, and it truly fits the long-term planning of what you have, what you want to do. So let's just kind of go over real quick a few types of life insurance, and I won't hold you long. But the first type of life insurance is a term policy. So a term policy is a temporary policy in the sense that for a fixed amount of time. It's not a permanent policy, which we'll go over later. You're going to have a time limit on a term policy, whether it's 10 years, 15 years, 20 years, 30 years. You do have some that go out longer than that, but that's typically what you're going to see on a term policy. So you get it for a specific term, and it's a stated premium that you pay for that period of time. Now, if you got a 20-year term policy, once you get past that 20th year, the premiums are astronomical at that point. So really what you look at and say, hey, I need 20-year term and I'm using for this period of time, and this is how much I have to pay for it. And here is the death benefit. The death benefit meaning this is what my beneficiaries will get. The younger you are, the cheaper it is. So, term policy typically is for the younger person, you can get more coverage for less money. Typically we're healthier when we're younger, and the term policy actuarially is priced where it's cheaper. So you can get that coverage. In many cases, you can get a term policy that's convertible. So meaning that anytime within that 20-year time frame, or that you may run into some health issues or whatever, and you want to make it a permanent policy. Again, we'll talk about permanent policies a little bit later. You can, and so that convertible nature is good. Now, one of the big drawbacks for term policies is that it is temporary, meaning that you have longevity. Typically, that term policy will no longer be enforced, especially at that same premium. Now, you can convert it, but you're going to convert it at a higher premium. But if you don't decide to convert it, the term expires, then you no longer have coverage. So if you didn't pass away in that time, you just pay 20 years of premium and you don't have any life insurance, nor do you have any other beneficial value from that term policy. And that's one of the negatives of term insurance. But it has its purpose, it has its place when you have a specific goal and a specific time frame of what you're trying to cover. So I would tell everybody who's looking to start out, who may have younger kids, cash flow is a concern, then term might be somewhere where your eyes should be drawn to first. If you're trying to build your cash reserve, build your investments, and you need to protect your family for a certain period of time, then term is one of the ways that you should definitely, one of the types of life insurance you should definitely be focusing on. Now, whether you should buy it or not, that's still is a nuanced decision, but that definitely should be something that you should look at and focus on. Then you got term policies, then you have permanent policies. Now, within the permanent policies, you have whole life, universal life, variable life. Those are permanent policies: whole life, universal life, variable life. And we'll go through each one of those. Now, whole life, again, a lot of this is based on my bias and my experience when it comes to life insurance. But whole life, to me, just to kind of give you the facts of it, you have a stated premium. It's a permanent policy. So once you're underwritten and you're approved for it, as long as you pay your premium, the agreed upon premium, you will have coverage, based on the guarantees of the life insurance company. So the life insurance company goes out of business and you don't have coverage. But again, like we talked about earlier, most of the time, these are some of the most secure financial companies that we have in the country. So you pay a stated premium and you have coverage for as long as you pay that premium. It builds cash value, right? So at some point in time, you'll have cash value, and sometimes those cash values have dividends and interest credits, and that helps build upon it. And you get prepaid, you get paid up portions of your life insurance, and there's value that's built up within the whole life policy over time. It just depends on how it's designed. One of the drawbacks to me with whole life is that it's not a transparent policy, which means I don't really know what are the formulas and how things are working with my interest crediting and what was my dividend, my participation when it comes to paid up policy. It's not very, and it's just not transparent, and the expenses of the policies aren't there. So you can get an illustration, you can see what the interest crediting is, but at the end of the day, you can, how that whole life policy works and what those mechanisms are, you don't necessarily see as well. Then we go to universal life, which is, again, another permanent policy. I'm paying a premium, and I can decide at the beginning what premium I want to pay. It builds cash value as well. It has an interest rate that's credited into that cash value. Now, that interest rate does adjust with market rates. So if interest rates are going up, then it'll go up slowly. When interest rate go down, your interest rate probably will go down quickly, that you're getting credited to your cash value. Expenses tend to be more transparent. You'll have in your illustrations, then you'll have columns of what the guaranteed expenses would be and what the current expenses would be. And so you can look at that and evaluate that policy and evaluate it against other policies pretty clearly. Be careful when you look at those, because when you look at the illustrations for those universal life policies, is because you want to see what interest rates being credited and if it's reasonable or not. Whatever those current rates are. And you also want to know what the guaranteed minimum rates. A lot of times is 1%. So that means that the insurance company can credit your interest expense as low as 1% if rates start to decline. So you won't get the same cash value buildup if you're seeing it illustrated at 5, but for most of the time in the policy, you're actually living in this only earning 1. This is something that you have to be very careful with. The universal life, the premium is flexible. You can change the premium around, but what you might run out, by changing the premium, you might run into that your policy may lapse, meaning that the expenses of the policy eats up the cash value and the premium is no longer covering the expenses of the policy. Because with universal life, the actual cost of life insurance is going up every year within the policy. And if you look at an illustration there, you can see that. So with universal life and variable life, you can see that as you get older, there are more cost of insurance expenses coming out of that policy. So again, something for you. I'm not trying to teach you how to be an expert here, trying to stay kind of high level, not get into the weeds here. But so universal life, you just want to be careful about the interest rate that you're seeing there, and you have to kind of determine for yourself if that's a reasonable rate. But remember that rate, because as the years go, you want to ask the question like, okay, you get a in-force illustration ran, what interest rate did I get credited this year? So if you're in year 5 of the policy, you want to know, hey, I remember we illustrated that at 5%, and now I'm getting 2%. How long am I going to get 2%? Is the policy going to perform like the original intent or illustration of the policy? Which leads us into variable life. So you got whole life, universal life, variable life. Variable life is similar to universal life in the sense that the premium is flexible, cash value is present, but with variable life, you have sub-accounts instead of the interest credited. Those sub-accounts are tied to market performance. So I can actually have a sub-account that's tied to the S&P 500 with variable life. And that would also, go up and down just like the market would. So if the market is going down, again, much like universal life is that interest rate could go down, you still be getting credited 1% in the universal life if it hits the guaranteed minimum. But in variable life, if the market goes down, you can actually have negative performance. So your cash value could go down and the expenses are going up, and which means that premium you're paying may not be covering everything that's needed to get you to your stated goal. So again, you have to be careful not only in the illustration, making sure that you're not seeing the variable life policy illustrated at an unreasonable rate. Sometimes people will illustrate those at 10, 9, 10% and make the cash value build up look really nice. But at the end of the day, it may be more reasonable for you to look at a 5 to 6% rate of return on the illustration. Not that it's guaranteed, but it will give you a better, more conservative way of looking at that variable life performances over a long period of time. And you have to always keep in mind that each and every year you need to be looking at this policy, because you want to know how did it perform last year. We illustrated this at 6, much like universal life, and I've been getting an average rate of return of 5 or 4. How would this affect my performance of the policy later so that the policy won't lapse as I get older and my cost of insurance is going up? Now, you'll see these variable universal life policies, variable life, universal life, whole life. You'll see them from time to time being sold as some type of retirement income vehicle. But you got to review those things annually if you want to really make it where it can have substantive cash value in order for you to be able to get a retirement income from it. This is, so you have to be very careful there. Also, with that variable life, you really need to be able to put a lot of money into it. So you want what we call overfund a variable life policy. You don't want to put a policy in place where you're just paying the minimum premium in variable life if you're doing some type of accumulation strategy for the cash value. If you're using more than just the death benefit, you want to be able to put a higher premium as much as you can. The government will allow you to put in that life insurance. You want to consider that, which requires more discretionary income. I've seen a lot of people fund these policies very skinny, which means that they're just putting enough to keep the policy in force based on the illustration, and the policy just doesn't perform well for cash value buildup. You still have your death benefit, which is what life insurance really should be about, but the policy does not stay in force longer. So you have to really be careful about even how you fund the policy. You got to be committed to funding it in overfunding it, getting close to what the government will allow you to put in. The other type of policy is the index universal life, an IUL, very similar to variable life. So I didn't mention it when we talk about permanent policy. Very similar, except there are caps and some other nuances there. It may have to be tied to some index, whether the S&P 500 or other policies, but it has a very similar characteristics of variable life. Just probably it could be deemed a little bit more conservative than variable life. Probably a little bit more aggressive. You can get a little bit more rate of return. Hope that's the thought in universal life when interest rates have been so low. So those are the different types of permanent policies. Then you have these hybrid policies that they're fairly newer, where you have life and you have long-term care. So if you're somebody in your 40s and 50s or 60s, then you can look and say, okay, hey, long-term care is something expensive that's going to happen if we live long enough and health starts to fail. How can we cover that risk? You can do it with a life long-term care hybrid, where you have life insurance, a death benefit, but at the same time you get to take care of any type of long-term care. So you can look at those policies as well and see if they fit. But it's truly if you have a long-term care need or protection that you're trying to put out there for yourself. Another type of policy is life insurance policy, is group life. Now, you get this as your employer, and my experience is it is often underutilized. It's a benefit that you have at work. It's much like term. You get the coverage. You'll have it as long as you're there as an employer, or as long as you're elected every benefit season. A lot of times employers will give you maybe $50,000 as a standard coverage that they pay for 1 times your salary. But if you want to get multiple times your salary, then you have to choose that benefit. Sometimes it's limited underwriting that you have to go to. Sometimes it's not. But I always encourage, especially people who have young families or building a family, or even in the latter stage in life, to get as much of that group coverage as possible, because it is a less expensive way to get coverage typically, because it's spread amongst all the people within the company, the risk is. And so you could probably get, if you're making $100,000 a year and you get 4 times your salary, you get $400,000, your family will get $400,000 if something happens to you. And typically that is a lot less expensive, especially when you're in your 40s and 50s, and you're still having an insurance need. That's a lot less expensive than probably going out in the marketplace. The problem with it is that, when you leave a company, a lot of times, even though it's portable most times, they come at a significant cost if you leave the company. So a lot of people lose that coverage when they leave a company, and that's a negative. So you don't own it, you don't build any cash value, and that's a negative with there. So which one of these is right for you? And I'm gonna say it depends, but you ask yourself these 6 questions. All right, question number 1 is how much income you make, meaning how much can you afford, right? So the income I make versus if I'm spending less than I'm making, then I can ask the question of how much can I afford, right? So if I can pay more than term, I can go ahead and get me a permanent policy, and I can overfund or fund it correctly, then maybe I can use that cash value build up, and I can have a policy that'll last me forever. Or if I don't make a lot, or if I spending as much as I'm making, I'm trying to save money in other areas, then I can't afford it. So you ask yourself, how much can you afford? But also asking how much income you make determines how much income needs to be replaced if you pass away prematurely. So, if I'm making 100,000 and 30 years old, and I have a 1-year-old, then look, I got to be able to take care of. If I passed away, then I want to be able to take care of my significant other, my 1-year-old, all the way through college, and so that takes a lot of money to replace my income. And so what amount of coverage do I need to get? What type of amount to help me answer that question? All right. So how much income you make is the first thing. How old are you? Your age makes a difference, right? The younger you are, maybe term with the option of converting later. As you start getting in your late 30s, maybe you might want to start thinking about more permanent coverage. By the time you get 50, term and permanent are probably very close in price. And so you might need to think of, do I need more life long-term care hybrid? And maybe I need to get some group coverage at work. I mean, all those things come into play. Your age makes a difference there. So how much income you make, how old are you? Then the third thing is, what's the purpose of the coverage? Is the purpose of the coverage to take care of young kids till they're grown? Is the purpose of the coverage to pay off your mortgage? Is the purpose of the coverage to replace your income for your significant other? Or is the purpose to buy business partners' family out if they pass away? If they pass away, if the business partner passes away, you want to buy their family out? Or is the purpose state taxes? Or is the purpose to build up cash value so that you can do this education, retirement income, or some other financial goals from the cash value? Maybe the purpose is all of those, but what's the purpose determines what we need to be focused on and the type of coverage that we have as well. What's your health look like? I know that's not probably one of these 6, but that also goes into that purpose part as well. How much coverage do you have now? So if I have a huge term policy and that term policy is going to last me 30 years, my kids are, 10 years old, and I just got this term policy that lasts me 30 years, then maybe I don't need a large coverage policy or another term policy. Maybe I can get a small permanent policy that covers, let's say the mortgage or something that I want from my significant other, and if I passed away, and maybe I can even use it for retirement income and overfund it, a smaller policy. How much coverage do you have now makes a difference. What type of assets do you have now? One of the biggest mistakes that I see people make is that they get these permanent policies, whole life, variable life, IULs, universal life. They get these permanent policies and they don't have enough cash on hand, meaning that they don't have enough reserves. And so what happens is some life event happens and you need money, and they try to go to these insurance policies, and that's not the best place to go. You need to have significant cash. You need to be maxing out your retirement plan. You need to be doing all those things before you delve so much into cash value life insurance. It has its place. It's a great financial tool, but it has to be in a proper order. Cash is king. You need to be able to take care of your family short-term needs that might come up when life happens. That's not you passing away. And so a term policy would probably be better for people who are cash reserve strapped. Okay. All right. So the next one is taxes a concern? So is it state taxes, income taxes now, income in the future, taxes? Because life insurance can be a great tax control vehicle. It can be. It's not totally meant for that, but that's one of the ways wealthy people use life insurance, is whether it's to help replenish their estate from estate taxes, to lower estate taxes, or to manage their income tax brackets in the future. So it can be used for that, but it's its proper place and time. So what I would tell you is think about all those 6 areas that we just talked about before you go and pick out what type. How much income you make, how old are you, what's the purpose of the coverage, how much coverage do you have now, what type of assets do you have now, and is taxes a concern for you? All right. So try to get the right type, amount, death benefit, and a premium that you can afford to make sure that this policy will fit your financial life now and in your financial plan going forward. Forbes magazine states that 68% of the people with life insurance feel more financially secure. Now, 47% of the people who don't have it, feel secure. So the more life insurance coverage, people who have the proper amount of life insurance coverage tend to feel like they're more financially secure, and their families do as well. So whatever type you get, just get it. And just remember that life insurance is for those that you leave behind. And I hope this helps. Hey, so I'm taping this episode right after Final Four weekend. And I just want to say congrats to the LSU women's basketball team. Now, that's probably the only time you're going to ever hear me say congrats to LSU. All right, I'm a Tulane grad, and I always felt like the little bitty stepbrother when I went to school at Tulane, because we did play LSU a few times in football while I was there. I mean, it used to be a rival. I mean, I guess you can say that, but we lost all the time, and so there's a little non-love for LSU. But I really truly enjoyed watching the championship game and watching the tournament. And what I want to say is that women's basketball is a great game to watch. I know a lot of people get, rib and say, hey, can't watch women's basketball. I don't know what these people are talking. So it is just a really good game to watch. And in today's world, my argument is that it's better than the collegiate women's game is better than the collegiate men's game right now. And I'll tell you why, especially when you get to tournament time, especially when you get to the Elite Eight and Final Four, because 99% of all the good basketball players who are women, the good ones are actually still playing collegiate basketball. Whereas the guys, they could be in the G League, they could be playing the NBA at the age of 21, 22, they could be overseas, they could be all over the world, the really, really good basketball players. And so the women have the top notch. I mean, Kaylin was out there balling. And, if she was a guy, she would be playing in the NBA probably right now at the age that she is. So you get to watch really good quality basketball. And one of the things, Kobe Bryant, rest his soul, he was a great basketball. He was a great basketball player. Now, for those who know me, know that as a basketball player, Kobe Bryant, especially in his younger days, was not my favorite basketball player. I didn't necessarily enjoy how he played the game early on. I loved his competitiveness. I mean, I always loved his competitiveness. But the way he played the basketball game, the shot selection and everything, I always said that Kobe Bryant was Michael Jordan without Dean Smith. So if you gave Kobe Bryant Dean Smith, then he would have been even closer to Michael Jordan, because he would have been able to play basketball in a way that's the purest form of the art. Now, I know that may be controversial, I think Kobe Bryant was a great ball player. But for me, one of the greatest parts of his legacy is how he supported women athletics and his daughter. That to me is one of the greatest parts of athletics. So this is post playing Kobe. I don't know what he did before he stopped playing, but post Kobe, the way he supported the WNBA, the way he supported collegiate women's basketball, the way he supported his own daughter, to me, that is, he made a change in how people view women athletics, whether it's the NBA players and how they supported and what they intentionally went out and did. I think that he was one of the catalysts for that. And to that, I think that's a great legacy for him. And I just love how he helped make the term girl dad really, really cool. And so for that, I will forever hold Kobe Bryant in the high esteem for how he did that. And so going back to, I'm going down a rabbit trail, but going back to the game at hand, I really did appreciate the way the tournament. South Carolina was a great team. Iowa's a great team. LSU's a great team. I enjoy watching, especially those three teams play. Now, the controversy around Angela Reese, I was going to jump on and say something about that and the LSU girls. As a person who has a daughter and I coach basketball and my kids, play sports and the competitive nature and me being competitive as well, I don't think that a lot of that controversy, well, just probably most good basketball players have some sort of court arrogance to them. Most elite athletes do, right? But most even decent basketball players do. And if you don't believe me, just go to any playground and listen to how much people are talking and how the person who's the best player on the court kind of walks around. They can not be really, really good. They don't have to be good at all. They can just be better than people out there, and they're going to carry themselves in a way. So most decent basketball players have a bit of court arrogance to them, men or women. Race doesn't matter, nationality doesn't matter. It just is what it is. It's something about the game of basketball and the one-on-one nature. And then once you beat that one person, you got to beat four more people to put this little ball in the hoop. That if you can do that proficiently, it brings a certain bit of arrogance to you, more so than a golfer, because the golfer not only plays players that they're playing a golf course. Tennis player, a lot of times, they are, even though that they have a great deal of confidence, it's different. It's not a mono or woman type, the physical nature. Football has it to a certain extent with the trash talk, but people probably would tell you that the biggest trash talkers are those who are farther away from the football at the beginning of the play. So the receivers and the cornerbacks, which probably in football is very similar to basketball. It's a lot of one-on-one type play. So again, that level of arrogance there. And so when they're in the emotion part of the game and the controversy around Angela Reese and what she did, now, did she take it a little too far? Maybe, maybe not. Did Caitlin take it a little too far? Maybe, maybe not. But you gotta love the passion. You gotta love the effort. The way they play. See, where I'm from, when you talk the talk, when you walk the walk, you can talk the talk. When you talk the talk, you better walk the walk. And Angela Reese, she walked the walk. Caitlin, she walked the walk. So they have earned the right on the court to talk. They have learned the right on the court to kind of rub it in a little bit, right? And so you give competitors who actually putting in the effort, who actually producing a little leeway. There's a thing such as sportsmanship, and we all who have played sports, and I know there are plenty of times that I wish I was a better sportsman than I was on the field, on the court. But that passion and the fact that we're talking about this right now is really good for women's basketball. The eyes are on it, and they should be, because the WNBA is nice. I don't know if you guys have watched the Las Vegas Aces play and all these teams. it's just some really good basketball out there played right now. And so I would encourage you guys and ladies to jump into the game, WNBA, college. Let's support the women and the men, and let's enjoy our time, because basketball is a beautiful sport. I love the way they run up and down the court. All right, so some of you guys will get that. All right, so thank you guys for joining us for this episode of Dads and Dollars. We really appreciate it. We know we missed last week, but we hope to give you a double dip at some point in time in the future. Like us, review us, give us 5 stars. Please give us 5 stars. We need them. And we look forward to catching up with you next time.
Thank you for joining us for this episode of Dads and Dollars. If you found the information shared today valuable, please share with your friends and family via your social media. If you have a request for a future financial topic for Dads and Dollars, please email us at ask@dadsanddollars.com. For further information on your financial journey, you may purchase The Quest for Financial Independence, 10 areas of your financial planning you should not ignore, by visiting our website, dadsanddollars.com. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Individual tax and legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to make a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. Asset allocation does not ensure a profit or protect against a loss. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of these strategies. Investing involves risk, including possible loss of principal. Guests and their companies are not affiliated with or endorsed by LPL Financial or Intellis Advisory Group. Securities offered through LPL Financial, member FINRA, SIPC. Advisory services offered through Intellis Advisory Group, a registered investment advisor. Intellis Advisory Group and Intellis Wealth Management are separate entities from LPL Financial.